Fires are raging inside of the financial system. I'm going to show you some details today that explain everything. We're talking about SVB. We're looking at all the latest banks that have come up inside this crisis. And I'm going to give you the details, the charts, as well as what's happening within the economy so that you can make the right decisions for yourself, for your families. I think this is really key right now because during this time, we've been highlighting for the past few years up until this moment how easy monetary policies, printing money, throwing it out there, is never a good thing. And now we're seeing the effects of it all. Okay, you came here for the truth, so let me unveil that for you. Let's begin by taking a look at this chart. This is important because even if you're not interested in like all the nuances of the financial system, it's really telling. And let me explain it. You have this light purple line. That's the MOVE index. And the MOVE index measures volatility inside the bond market. And then you have the others, which is basically looking at the stock market volatility. And when we compare these two, they are wildly different. Now, there's always going to be variances, of course, just like anything else. But usually they would kind of correspond to each other. Okay, that doesn't mean that the stock market's going up at the same time the bond market's going up or going down and going down. It doesn't work like that. It's the volatility. And so today we're seeing something very different. And these typically happen. And what occurs, the reason I mention this, is that one of them is wrong and one of them is right. And we're going to see how they converge. Is it that the volatility in the stock market is going to go much higher, or is everything going to calm down in bond market land and things are going to return to normal? Well, we'll see, right? We're going to look at some of what's happening here and the potential economic dangers, market instability, drops in diesel prices, and rising inflation, and how these actually have a material impact. That's what we have next, okay? You could see it. Equity volatility stays high past FOMC decisions. So the Federal Reserve increased interest rates by 0.25%, 25 basis points. And you could see here, they just show you different examples going through uncertainty surrounding macroeconomic data has increased. So the S&P 500 index implied volatility on this chart here coming out of Bloomberg, 43.4 around an FOMC rate decision. And so that's big. It tells us that markets coming around those decisions, they're unstable. They're, like sort of pricing all of that in. What do we do? I don't know, all that. So we can see that that is a big decision that came through. And now we, of course, see the impact of it. The markets were really hoping for a halt in interest rates increases, but that did not happen. This chart is showing us European stocks bouncing off the technical support levels. So what that means to you is that in Europe, things are looking a little bit more secure in the stock market. Maybe they'll kind of balance out around here if there aren't any more failures. And that is the type of thing that we only know in time. I think that they've made it very clear that they still want to be strong on inflation. You look at the ECB and what they've said, we are going to make sure that inflation stops right here. What about for the UK? Same scenario, right? We're going to make sure we take care of inflation. Okay, they're still going to have to do stimulus after this because you know what happens after a period of tightness. They're going to have to just get those printing presses running 24/7. So we'll see what happens in that respect. Okay, look at it here with diesel prices dropping. It's an economic danger sign. And this is, there are many reasons for this. I mean, we're coming off some serious highs. And so that's always a factor that I like to think about. But for some people, they'll point to one thing or another. This happens to be just one. Here, diesel prices at the pump have fallen to the lowest levels in over a year. That's good news for consumers, but the decline in prices for fuel suggests a gloomy outlook when it comes to the US economy. Diesel fuel is ubiquitous in our economy. It's a critical component in industrial production and supply chain dynamics. So if that's coming down, what does it tell you about what's going on here? Less demand, less stuff is being moved, less stuff transported. There is overall less. That means economic slowdown, economic contraction. I don't know if I pulled it up in this video here, but I've seen the charts now, and over the past month or two, a lot of the data has bottomed out and come back up when it relates to manufacturing and production. That's a good sign. That's a good sign for the economy. However, banks, if they keep failing, okay, then we got a big problem. If that was the last of them, if SVB, Signature, all that, if that's kind of it, you can bet your bottom dollar that investors are going to be going hand over fist into this. Okay, so watch out very clearly. But the data is mixed, and don't believe anybody who tells you it's just one thing only. This is all you need. Just look at this. Just buy, 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 buy. It's not like that. Okay, it's very risky behavior and should be ignored at all costs. Look at this. This is the one. Yes, exactly. You're looking at the manufacturing PMIs as well as the services PMI. Both of them have come up now. So we're looking at that data. All it means is through 2023, this has started to improve. Conditions in this respect have improved. Now, we've seen these bounces before and then it turns down even further. However, we are basically right around that contraction territory here. That is not a good growth story. That's not what you want to see, but that's the truth. Okay, so I'm not here to paint a rosy picture. I'm certainly just here to give you the information you need. As I said in the previous videos, for you as an investor, as an individual, you got to watch where your money is. So I would be very careful if I was keeping my money in all these different banks, having way too much cash in any one account. They're not going to be able to insure it. They already spent through a large percentage just for one example. But you know, what happens if 3, 4, 5, 6 banks start to fail? You got a big problem. Maybe they'll print money. Maybe they'll, the government will come in and bail it out. But that's just inflation. So you got to be very worried about how they're going to deal with all of this. Here you can see just a breakdown. This is the actual report from market. But looking at it, you'll see same information. Things are at, in some cases, a 5-month high up to an 11-month high on their different reports. So when I look at that, I say, okay, is this part of a bounce, or is it actually now we found the bottom, new growth is coming? It happens to align, very much happens to align with the bottom of the stock market. Is that something that should be considered? Because at that time frame, October, September time frame in 2022, I was telling people it looks like at least a near-term bottom. Now we got the banking crisis and everything kind of throwing that off. But I do believe that when you look at this, it makes a lot of sense, because that's when they started to signal that they were going to be a lot less restrictive, and the markets took that as, okay, eventually we're going to get our pivot that we're looking for and so on. And that's just the name of the game. So we only know in time, but I would think watch it very carefully, watch those details, okay? Don't ignore it. Now this right here is talking about what's happening with jobs and so on. And for a lot of people, you got to be careful, because they believe that their job is so safe and secure, but it not necessarily is, okay? Job cuts and financial difficulties facing companies and industries, that's going on right now. It's not something as if we got to look into the future. It's happening today. From big tech layoffs to warnings of default waves in Latin America, we'll explore what these developments mean for the economy and how they could affect your job outlook. I know a lot of people are worried right now, and for good reason, but if we stay ahead of the information, we're going to be ahead of the curve, and I think there's a lot that people can do, and I'll be talking about that more in Education Week. Here we have S&P warns of default wave ahead of Latin America. Here we go. Rates are rising. Defaults may pick up in Brazil due to floating rate debts. And that's a big concern. Big stuff coming right now. I'd be very worried about that for a lot of people who have invested there or simply affected by it because you live there. Looking at this, you could see that there's a lot of similarities between 2008, but it's not exactly the same. Okay, don't get sucked into that either. It's a mess. I'll tell you that. Accenture to cut 19,000 jobs as IT spending slows. They're just one of many. Another company, Amazon to lay off another 9,000 employees. This has been really, for good reason, a concern. But I wanted to show you a chart that I found. these are all reloading right now. I wanted to show you this chart. Tech companies laying off workers after the hiring sprees. Remember, they were hiring like crazy. One of those companies, I thought this was interesting, watch this, Amazon, 746,000. 746,000 employees. Unbelievable. And look, and you can compare it to the layoffs. So they announced 18,000 layoffs compared to 746,000 hires. So when you look at it like this, certainly it's not a huge deal. Compare that with Google, for instance, 68,000, and they're laying off 12,000. You know, that's just the way it is. You can see it in terms of percentage change, okay? So some companies getting rid of more than the others, but certainly we have to watch this because I think for a lot of people, they're just wondering what's happening. Tech is one that is getting hit really hard. But of course, if the banks continue on with what they're doing now, even if there's no more failures, but this kind of like worry, then I would say the financial industry could get hit even harder from this point. So that's another thing. So what I wanted to talk about really quickly was the government debt, taxes, increasing government payments. Like think about the interest payments that are happening right now. Interest rates are rising. The payments on the debt are becoming completely unpayable. Completely. And they're making it seem as if it's manageable, but we know that it's not. They can always print more money for that, but that just means your dollar value has declined considerably. And that's part of it. Look at this chart, okay? It's crazy. All commercial banks just showing us like versus the GDP. And when we see this, to me, this is shocking to see how much money has been pulled out. This is the deposits versus the GDP. So we can measure it in that way. And you can see a lot of these individuals are just worried. They're worried. And why? Because they've seen it before. This is the largest outflows we've ever seen, which connects me into this. Interest payments on the treasury debt up 29% year over year. Interest rates have risen considerably, and you know that they cannot pay this back. So you've got trouble here. So I wouldn't trust anything. That's the way I look at this. That's the way I look at all these investments. We can't trust them. We can't really believe that the banks are going to be safe and secure tomorrow. So what do? Well, we don't want to hold our cash in the banks. We want to have our cash in a place that is real, that is tangible, that is physical. And we want to hopefully be able, depending on which asset class we're talking about, there are 4 asset classes, talked about it in my first book, where we're going to want cash flow from that. Now, why do we want cash flow? Because if something is just like all our wealth is in something that's just sitting there and we're relying on our income. Okay, don't worry, I'm fine. I got this income coming through and I'm going to be buying into this one asset. Well, if suddenly you don't have income coming in through that one stream, then what are you going to do about that asset? You're going to start selling it. You start to sell that asset, maybe it's not the right time. Maybe it's a 50% down from where it was at the peak. And you think to yourself, man, I don't want to do this. I don't want to sell right now. But maybe you have to. And these type of things happen all the time because of a health problem, because of financial problems, because somebody in your family needs you at that time. Somebody needs to borrow, you need to borrow, whatever the case may be. It could be for financial health, anything. And these things do happen. And so we want to have streams. We want to have different sources of income and we want to have different assets. So if an asset, even if it was a small percentage, is paying us every month, we know that we are safe. Okay, that's going to pay off my mortgage payment. This is going to pay off my utility bills and so on, you see? And that's really important. That's the way we should be thinking, not necessarily just take everything and park it in one place. That's not a sound way to invest. I promise you, I will break this down further in Education Week, which is coming up early part of April. So I'm going to bring that to you. It will be 2 videos a day, purely of education, no news. I noticed a lot of people were excited about that, and I am too. So I want you to stay tuned for it. If you're not already an insider, you've got to be. How do you do that? Scroll down at the AmazonGPS.com, scroll down to the bottom and fill in your email address. I will send you the video of the day. And one very important point of the day, you don't want to miss that. It's totally free. It's right here or at the AmazonGPS.com. I'll see you there.